Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Great. All right. So great to be here this lovely Wednesday. We have my amazing guest, Brent Ritchie, who's going to also introduce his reason for being, right, Brent?
That's right. That's right. Yes, these are 3 little ones. So we got Violet, Vienna, and Ava, and my beautiful wife, Stephanie. So these are the ones holding the fort down and making it all happen while I go crazy with real estate.
Hi, ladies. Great to see you again.
Hi, good to see you too.
Do you remember your Chinese? Ni hao, kung xi fa cai.
Oh yeah.
Oh yeah. Very good, very good. I saw them over Chinese New Year, and they had a little bit of red envelope, so they were very happy about that.
Yes.
Okay.
Yes, I got them excited right away.
Great, great.
Awesome, man. Awesome. Well, sounds good.
Okay.
Yes. Well, thanks for saying hi.
Yeah.
Thanks,
Bye-bye.
ladies. Okay, great. Okay, so let's get started. So again, my name is San Ing. Thanks for showing up. You see this book behind me. We started this series, what we call the Wizards Learning Series, initially with my nephew Timmy, who just graduated Columbia, and my daughter Ia, who just graduated high school, as research for the book. Really interviewing, documenting in a video or podcast all the smart people, the greatest investment wizards. And the book is published. In fact, it's doing quite well. The paperback's coming out this month, and we hit Wall Street Journal and USA Today. But because I found these interviews so interesting to learn from smart people and successful people, even though the book is published, we continue to do these interviews, trying to do 2 or 3 a month so we can keep learning and documenting in a podcast. Oh, thanks, Jenny. You actually pay for a copy. That's great.
Yes, I paid for it.
Yeah. By the way, all the profits of the book are actually donated to a charity. So we're really doing this for hopefully teaching the next generation about investing. And in this research and for the book, but also in my own experience as a professional investor and running a modest family office, essentially I came upon multifamily as one of my favorite, if not my favorite, asset classes. So for the book and for this Wizards platform, learning platform, we actually do quite a bit of multifamily learning, and hence why I invited Brent. I've actually been looking forward to this. I've known Brent for some time now. We've looked at quite a few deals, but really wanted a chance to sit down formally and hear the full story. So Brent, maybe without further ado, why don't you give us your bio and sort of how you got here. And you're now at 2,500 doors, not 1,400. So we're way behind in the description.
No, it's great. It's great. Yeah, so good to meet everybody. Good to be connected here, and several familiar faces, which is awesome. And so I guess I've always been entrepreneurial at heart. Always had that in my DNA. From doing like snow shoveling businesses. Remember, I'm Canadian, right? So you got snow shoveling businesses in the wintertime, or you're doing lawns and everything in the neighborhood, and just kind of hustling and selling, and junior achievements, and eventually connected with the book once I was kind of right around about to go into engineering, Rich Dad Poor Dad and Robert Kiyosaki. And I know so many people have read that book, and it was really just a huge paradigm shift in just the way you look at everything and the way you view kind of opportunities and what you ultimately, if you're building assets or you're building, kind of time for money. And so that's really what had me kind of starting the journey, really, or maybe continuing the journey, but really just jump-starting the journey of entrepreneurialism. Several different entrepreneurial ventures, several different businesses, and then eventually came across the Real Estate Radio Guys podcast, and then they were talking about this whole, you don't need to start in single family to go to multifamily. You can really just start in multifamily, and it's actually easier to own bigger units rather than smaller, 5, 10, 15 units. And then just several different paradigms that really broke and shattered. And that's what introduced me to to a gentleman and a group and this whole ecosystem about learning everything apartment investing. And so that's where I met a lot of these wonderful familiar faces and really got connected down the road into the multifamily space. So I mean, it would really, you know, I guess from taking business from ideas to trying to be profitable or sometimes profitable, learn that, you know, maybe I want to find a tried, true, proven method that we can just, you know, almost like you're buying a franchise, or you're getting into a system that's already been proven out, and so you're able to yeah, just jump in that way. And it's really, for me, I was kind of 3 criteria of really what I wanted is something I can do from anywhere, right? I want to be able to do anywhere in the world, just need an internet connection. Something that I'm not actively involved in, right? I looked at some franchises, but if you're 60, 70 hours a week, I didn't want that specific style of business. And so something that you're able to kind of own, operate, and oversee your business plan, but you're not involved in the day-to-day. And so that was really my criteria, looking at a business and then figuring out what did my lifestyle want to look like, and then really tailoring and looking for a business, you know, that created those opportunities. So that is I guess a little bit of the background that really went into this getting into this business.
Thank you for that. So I'm a year and a half into multifamily myself, so I'm a very new. I know that you joined this group that I also joined July 2019, right? Pretty recently. And then at that time you were working as a full-time engineer.
Yeah, July 2017 went to the rat race to retirement, and then September, I guess, ended up.
Yeah.
But yeah.
So July 2017, you didn't have much experience. And then I know that a year ago, January, you basically quit your job and you're now full-time, you know, semi-retired, living off the passive income. And as of today, you're over 2,500 doors in terms of what you manage. I mean, that's a pretty, I mean, this is where I want to be. And I think many of us, how did you get there so quickly?
Yeah, some fantastic and very gracious investors, and I think really just, it's like laying the foundation. And it did take, it probably took me over a year to really buy my first transaction, right? And you're looking at a lot of deals, and you're just learning kind of the soup to nuts, getting in and how to, going green from you don't know much about multifamily into just learning all about the fundamentals, the basics, underwriting, having coaches, having an ecosystem, having a complete capability to really to do that, and having the confidence in the team of people that have been there before, that it's not like I don't know, I'm an engineer by trade, and so I'm probably technical and maybe too technical for a lot of people, get lost in the details sometimes. But really, I wanted something that was not just speculative, and something that's based on, more finite information, and something that you're able to dial in a pretty good projection of where you can take your business. And so that was really kind of on the multifamily side,
but Brent, I think you're maybe being modest. This group, and there are many of these mentoring groups. The group that you and I are in, where we met, has I think 1,000 folks in there. But most people, there are quite a few people I know, in fact, more than less, don't close deals. Not to mention that in 3-4 years, get to 2,000 plus deals, right? So beyond the system, which everybody pays for, I pay for it, right? What did you do that's different? Whether it's a strategy, effort, whatever it is, mindset that got you from 0 doors in July 2017. And I mean, frankly, you had a full-time job at that time. Ava, your youngest, I think was 2 years old. And Vienna's maybe 4, and then Violet was 6 years old. They were like little kids, right? And you kind of dove in, and you had three babies. Then honestly, I mean, I'm not just saying this. It's kind of a, how did you get from that full-time job with no experience? Again, there's 1,000 other people with the same tools that you're talking about, same mentoring, but then, you kind of broke out. what happened there? And you know, how can we learn from that?
Yeah, no, that's a good question, and I would say maybe from another country as well. So a couple more hurdles where prior to that, nobody in the summer.
That's true. You're not even American. You're in Toronto. Actually, you're not even in Toronto. You're in the suburbs of Toronto. So you're like, you have that disadvantage, if you call it, of not even being in the States.
Yeah.
Right.
Yeah.
Yeah. So yeah. So what was different about it? Is there a process you took?
And nobody at that time had bought in the Sunrock ecosystem from outside of the US, you know? So I guess was the first kind of pioneer. So you got to be a little bit crazy. So maybe there's a little bit of that. And I think just really that drive, like, what do you want? What do you really want with your life? And life is short and it's sweet, but we want to make the most of it, right? And so for me, it's like that, would I rather work 80 hours now so I could work 10 hours later, right? Or do I want to just continue down this road and this path to get to, you know, ultimately retiring, and then the plan with, you know, RSPs or TFSAs or whatever they are in the US, right? With your Roth, it's almost like you want to be making less income. And it's like, I never liked that strategy, that plan, that, you know, direction of work hard all your whole life and then hopefully save up enough money and that you have enough to make it before you die, right? It's a terrible strategy. And so I never liked that. And that's really, I guess, a bunch of the things that drove me to do something different, right? You work at a couple of jobs when you have some people and some colleagues that you maybe have some more challenging times with, that also create some good drive to do something different. And so, yeah, I would say, you know, it's just really what drove me is, you know, what do I want to do differently, and what do I want my life to look like? And you know, Sunrock talks about retiring 5 years or less. You know, fortunately, we were able to do that. But so it's like having that drive, having that burning desire of what you want to do, and then, you know, you've set a course for, hey, this is what I love my life to look like, and this is the system to allow me to do that. So for me, it's like, okay, I had the tools, I had this system, I had the group to be able to do that, and so now it's just let's go. And so, yeah, I mean, woke up, you know, I like Sam mentioned, 3 young kids, you know, and so you gotta, you know, have time for your kids, time for your wife and your job, you know, and then be able to do this on the side, and yeah, from another country. So yeah, it's really, it was not, you know, 5 a.m. waking up every day for years, and then kids go to bed, you know, and so typically I'd have, you know, during the work hours, and then, you know, after work, right, maybe a little bit there, but typically not until the kids go to bed. And then once the kids went to bed, and then, you know, kind of looking at some more deals and underwriting, sure, and working on it. And so it was a lot of burning the candle, I think, at maybe 3 or 4 places at a time. Sure. But you know, it's really, I think, just a speed of how bad do you want it, and how, you know, how hard are you going to work to make it happen. And so that's I guess for me, you know, it's definitely some good drivers. And yeah.
Mm-hmm. So Brent, since January 2020, you quit your job and you're focused on multifamily. And I know you recently, obviously, Mike and I and Mark, it sounds like we were also investors in this massive deal in Houston, 1,300 doors, which you guys raised some insane amount, $26 million equity in like a week or something, right? And then we're obviously working on some deals in Florida. How to get to your level of portfolio, are you more or less full-time now, or like how, you know, what kind of hours are you putting in to get this kind of results?
Yeah, so
it's not 4-hour work week.
It's not
right. It's definitely not 4-hour work week.
No. I mean, once you stabilize your deal, you could get it down, you know. But yeah, in the early stages, it's significant amount of work to find and underwrite. You know, we have a very strict criteria, and a lot of people say that, but we truly do have a very strict conservative criteria. So it just means you're going to underwrite a lot more deals to try to find the opportunities that make sense, and find the the yields that you can have a tried, true, proven system to get and make happen. And so, yeah, I mean, just breaking that down. So 26, 28 doors, a bunch of those, I was fortunate to work with another business partner and kind of scale things up and manage, do consulting with him. And then, you know, a bunch of properties under, you know, a property right now that we have under contract. And then another one, we're doing a 67 million Class A development in Central Florida. And then, yeah, we were fortunate to buy that 1,330 unit West Chase property that we just closed on the 8th. So what does that make it? Last Tuesday. Yeah, so we were just a great group of people, and most importantly, a fantastic group of investors. So.
Okay.
Yeah. So I mean, you know, I think it's just really, I don't know what is it? It's, you know, I guess staying at it, right? It's being in the right place. It's having consistency. You know, it's the long game, right? You're always playing the long game, and you're looking at long-term relationships. Everything's long-term, right? Your integrity is everything in this space. It's a small enough space. And so, you know, just do what you say and say what you do, right? And so just building everything we look at is about that long-term relationship, you know, from everybody on the team, from different partners and different sponsors and investors, and, you know, your property management company. And so, but hey, I'm not perfect. Definitely got lots of things to learn, and yeah, working with fantastic people like yourself, Sam. So just like iron sharpens iron, really get the opportunity to always learn and grow and develop.
I mean, sorry. I actually have a lot of questions, but maybe I'll just ask one more, and then we can open up to the folks that want to ask. So keep it more interactive. So I love the sort of the larger multifamily, because unlike my brother Mike and Jenny and her husband, and I'm sure some folks, I don't have any skills in terms of management or construction or any of the engineering background. So I like larger ones for property, with the property management. So for me, I love the schedule, because I, like you, I have 3 daughters. And so I just get up early in the morning. Sometimes it's 5:30 to 9 a.m. Sometimes it's a bit later, late morning, but typically I'm pretty much done with work by before lunch, way before lunch. And then the afternoons I'm free up to hang out with the kids and go to the gym. It pretty much the day is free, right? But it's certainly not like no work. It's definitely work, but it's just extremely flexible and can be done anywhere, at a Panera, at a Starbucks in Tampa, Toronto, New York, New Jersey, right? So that's great. So I was trying to get to how you sort of set your processes there, Brent. Sort of maybe as my final question before we toss this out to the audience. Do you have a certain system in place, given how young your kids are?
Yeah, I mean, definitely, you know, trying to carve out that time. I would say, yeah, I'm full-time in this now. And so always supper till they're in bed, right? I always try to carve out that window of time to just play with them, right? We're playing dodgeball on the lawn, or you're playing hide and go seek or tag or whatever, you know. I'm naturally, my middle child's climbing gym, and so she likes to climb me everywhere I am. So yeah, I guess just, you know, I love that as well, right? Just kind of that early morning before the kids are awake, kind of crush out, you know, a good 90-minute jam session before, you know, have breakfast with them. And then kind of after breakfast till, you know, yeah, it's till noon or beyond. It really depends on the day and what's going on, but very flexible schedule for sure in doing that. But I would really say it's probably depends on what phase I'm at, right? If I'm continually buying more deals, or if I'm, you know, just, okay, I'm in the middle of a deal, a transaction, then it's I guess it's a flexible schedule. And like you say, you can do from anywhere, right? From your Tesla, driving all over Florida, or
yeah. Well, again, and I don't work. I don't have a W-2 job. But for you, having 3 young kids, you know, just to summarize, is you started doing this larger multifamily July 2017 with a full-time job, full-time dad, and then less than a year and a half later, 2.5 years later, you basically have acquired enough passive income and deals to quit and do this full time, and now a lot more flexible. So that's pretty amazing because again, I'm doing this. I've been very lucky this year with Florida and deals, but again, I've got older kids and I don't have a job, so I'm really impressed with how fast you've done this and acquire your properties. So maybe I'll just pause there. Maybe Mark or Jen or Jenny, anyone else that might have certain questions to ask you, maybe they can jump in.
So Brent, how did you start? And just for the audience, so we were at I couldn't even tell you what year it was. We were at a Christmas party, and my wife Crystal and I happened to be sitting at a table, and Randy Lawrence and his wife were there, and we were just talking and introducing, and then Brent walked by and sat down, and we started chatting, and then they were saying about the Phoenix deal that they were having. I said, okay, well, Brent, you never even sent me an email about it. So after he flew back to Toronto, sent me the email, and I said, great, I'll invest with you. So part of that data point is, I'll always be willing to share, hey, we got something, if you're interested, I'll reach out to you, kind of thing. But back to the question, Brett, how did that transpire, one, Phoenix, and with Randy?
Yeah, no, great question. And Raj, great having you on as well. So yeah, with that, it was really, I lived in Florida for a little bit. I was 12 and 13, and so I loved the Florida market. It's a hot market. And so I was looking in that Central Florida market, and then it was like, hey, I'm green, find somebody that's more experienced in that marketplace already, work with them, right? Add value to them. How can we add value? And so that's really when I connected with Randy, and then it was like, hey, I'll be the one looking at the deals, underwriting, doing all the work. Once we get something that looks good, hey, let's look at it together and let's start down that path. And so that's really where me and Randy connected, and then just really started looking at a lot more deals and transactions. Getting close, but not getting any traction, then that's where I started looking in other markets. And so that's really where we started looking in the Phoenix market. This was 2018, end of 2018. And at that time, oh man, you can look back and know what you know now. I would have bought every single thing I could and not done a agency debt, but done a bridge loan. But anyway, yeah, so that deal in Phoenix was just, okay, let's start looking at deals in Phoenix. It wasn't as competitive as, say, Tampa or Orlando. And so that's where it really was like, okay, I'm looking in Florida and I'm also looking in Phoenix. And that was a lot of those early morning 5 a.m.s, after the kids go to bed, just everything that was on the market, constantly underwriting, connecting with the brokers, property management companies, just putting it really all together. And so, yeah, that's where we were, I guess, fortunate to be able to, finally get that property under contract. And actually, we were invested final. We were not the winners. That one fell out of contract. We were, I guess, called to the table to be able to, hey, do you guys want to look at it again? And then that's where, ultimately we were successful in buying that one. But yeah,
I understand. I'm not in that deal. I didn't meet you then, Brent, but my understanding is that deal's done really well.
Yeah, no, we're fortunate, and we've been able to do 10% distributions the last couple of quarters, and the same will be true for this next quarter coming out. So, Mark, you'll enjoy that.
Absolutely.
And yeah, no. In addition to that, we've really seen values go up dramatically, and we've been fortunate to be able to double investors' money based on a recent broker opinion of value there in less than 2 years. And so now it's just going up, right? We bought that one at, I'm trying to remember, 96, 98 a door. A deal right around the corner, just sold for 170 a door. Similar vintage.
How many years? 2 years, you said?
Yeah, just over 2 years. Yeah.
Nice. So it looks like they're close to a doubling plus 10% cash on cash.
Yeah,
not too shabby.
So it's good. We've definitely enjoyed that product, that asset, and I don't have a crystal ball, but a lot of the same trends we see with this West Chase opportunity, and a lot of deals that we look at, we just underwrite conservatively, right? You look at the hey, if we're buying here, instead of saying our price is going up, what if there's a correction? We want to say maybe they're down here, and so we're going to underwrite here. But I mean, if your market keeps going up, then your 5-year time frame compresses down.
I think there's a few in the audience here. Mike does smaller multifamily bird. Jenny was quite modest in her intro, but she and her husband does quite a bit of singles, and they do quite well. I'd love to hear what more from Connie, Shirley, and Raj. But me, and there's been a lot of discussion with Brent. In your view, being sort of using the engineer's mindset, you could have done many types of real estate. Maybe just in your own perspective, why did you choose multifamily? Maybe just share your perspective on that.
Yeah, I mean, it's
and syndication, right? Multifamily.
Yes, yeah, no, great question. You know what? It was almost like, okay, so I'm doing engineering, right? If I want to replace my cash flow, if I want to replace my income from my job, I would need to buy a lot of houses to replace that income. So then that's where it was looking at, okay, instead of having to buy, however many houses, X amount of houses, just on the cash flow basis, I could probably do that same thing, except now just multiply the number of doors, right? Is it 1, 2 apartments, right? We were fortunate in our first apartment was 120 doors. And then, do we just choose how many doors, right? And so it's a very, very scalable system. And it's really, I guess, just, there's that aspect. And, and I think my engineering side has caused me to become less handy, and as I tried to test my handy work, I quickly reminded how not handy I am, including putting some silicone where it should have been some clear caulking on all of my baseboards. That has now become like a nice little fly trap. So I'm constantly reminded how my skill set maybe is better in one area, underwriting, buying, syndicating, putting deals together, than anything handyman related. And so it's really a function of that. I guess I'm not that good at this side of the fence, and so stay in my lane and where I can, do better and thrive. And then time value for money, right? So if I'm putting time in, what kind of has the best yield for your efforts? So
anyone have questions?
Yeah, I thought, Mike, you would have been all over depreciation, but sorry, Jenny, did you?
Yeah, I have a question. So prior to being a sponsor of multifamily syndication deals, did you have any exposure to the asset class? I ask because I'm new to the this type of investment. So I wonder what kind of advice, that you have for me as as a passive investor, like what to look for, how to analyze deals.
Yeah, no, that's paramount, for sure. So no, it's a really, really good question. I guess just as an investor and analyzing deals, first I would say there's, I don't know, I look at maybe 3 factors. First one is the person, right? The sponsors. Do I trust them? Ultimately, do I trust them with my money? If I'm going to put 100,000, 200,000, 300,000, do I trust them, right? And so that's where that is, for me, that's step number 1. And so as long as it's somebody that you trust, then what's their track record like, right? What is their track record of doing these deals before? And, if it's something that they've done before, they have the track record for it, they got, credibility for it, it's something, other people around that, hey, they know what they're doing, they're true to their word. And so, I mean, there's people that are playing more the short game, and there's people that won't be necessarily honest. And I think that's a terrible strategy, and it's going to bite them big time, right? Because that won't last. But yeah, as more and more people in the ecosystem and more people in the group, then that's where people can't hide in that space, so you know, it's just really, I think just having the people to trust, and then yeah, that they know what they're doing. And then next, you know, the deal in the market. I could buy a fantastic deal in a crappy market and likely it's going to struggle, right? So if I'm buying a good deal that's well positioned, that I'm have a proven strategy of what I can do, and it's maybe not great, but I'm entrepreneurial at spirit, but I also, you know, we have a huge fiduciary responsibility to our investors. And so I'm not going to be, I guess, as entrepreneurial in my business, you know, dealings. And what I mean by that, I'm going to buy an apartment that I have these other apartments around me that are already proven out what I can do. So I'm looking at this asset and I see these are my two, three, four comps right around me that have already proven out, hey, if you renovate your units, hey, if you do these, you know, upgrades, you do these exterior packages, you know, you take a tired property, you bring it up, then you can, you know, you already have a proven path of what you can do. And so very similar, you know, it's we can get, you know, you can get more into the nuances, and there's a lot more because it's a bigger asset and it's commercial, and you know, you're having a lot of families that are living there, but really your fundamentals are still the same, right? People want good, affordable housing, and you take a property, you fix it up, you renovate it, you're going to get the type of tenants that will move in there, that will want to be there, and that we also want to have tenants, right? It's like when you see a property that's really run down, it concerns me a little bit for the tenants that are living there now that would choose to actively live in that, where, you know, maybe there's other assets that would be more appealing. And so, you know, you get really the ability to do right to your tenant and take a property and fix it up and renovate it, just similar to a house, to a concept. It's just on a you know, different scale. But yeah, it's just, you know, it's that treat people the way you want to be treated, you know, take the same amount of you know, respect, and do things right, do things proper, and you know.
So I think Brent, Jenny, that's a great question, and Brent, great perspective. I think maybe just if I'm trying to understand what Jenny's trying to get to, Jenny has a lot of cash.
No,
No. Come on, Jenny. I know for a fact there's quite a few folks here that have money to deploy, and the question is, well, where do they deploy it at? And it's a simple question, but it's actually a very difficult answer. I know the same for my, you know, Brent and I are part of this system. I'm not going to name names because we're not selling any system here, but we happen to have joined a system. I think, Brent, we pay about $25,000 a year for 2 years. I mean, for 2 years for the mentorship program.
Yes.
And so that entry price itself screens out some of the more lightweight players. And then within the 1,000 or so students in this group, maybe 30%, Brent, are active GPs like us, and 70% are pure passive, would you say?
Yeah, you know, that's a
Something
good
like that?
question. Mix, probably something like that.
Yeah, something like that, right? So there's, you know, 600-700 people that are purely investing, and then there's 200-300 folks like me and Brent that are also investing, but also sponsoring. And I think the you know, from my experience, it's only been a year and a half, a year really when I joined, is even in this group where there's a very strict underwriting criteria, Jenny. I think this group, probably amongst the different groups in America, is known as the sort of the more conservative group with very tight assumptions. So I ended up spending my first year talking to probably 50-60 people in the group. So some of the folks that are very active like Brent, and some very active investors like Mark. And I found some folks that have done 30-50 deals. And my learning is, you know, maybe half don't make the numbers based on my interviews with the folks that have been interviewing for 5-10 years with this group. And so it comes down to what Brent said, is which of the GPs are actually, even following this very strict criteria, right, Brent, are actually performing. And so it comes down to kind of like spending the time to find out who the sponsors are not exaggerating, even within this group. and it just takes time. I personally invested in Brent in this Houston deal. I think there's a few of us that did because of Brent, but because there's also a couple of sponsors in there that I've met in the past year that have also stellar reputation. So at the end of the day, it just makes sense. Just good people in the group. Sorry, I didn't mean to interject, but I thought that was a process that I'm going through myself. Yeah. Hey, Jim, show your handsome face.
You might not be ready. Mark, did you have a question?
No.
Okay. And Raj, do you mind, and Jim, since you guys came in a bit late, do you want to introduce yourselves if you don't mind?
Yeah. Can you hear me, Sam?
Yes.
Oh, okay. I'm from Tampa Bay, Florida. I'm an IT guy, into computer science and masters in computer science. And after that, this real estate bug caught me. I'm into yoga, meditation, giving back, and then mainly passionate about real estating. I enjoy. And then, I took just like mentor course around 2016 timeframe. I was doing single family in Tampa Bay at that time. And then I understood the multifamily game. And I'm also a passive investor in almost like 14 to 15 deals. And, with 7 or 8 sponsors, I keep on doing it whenever I have money. I like Jim. Jim sent me a deal. Actually, I was thinking to invest, but because of the other alternatives I have, I went with other investment at that point. Then I met San, and then I thought like, okay, this guy is good. So I just need to hang out with these people so that I can get exposure to different opportunities. And I'd like to spend time with people like you. So that's the reason I'm here. So I just want to keep on educating myself and impacting people or help anybody, in whatever way.
That's great. That's great. Thanks, Raj. Well, I learned initially from my brother Mike, who's there, and then Jenny and her husband, and obviously Brent as well, and Jim. So yeah, it's always about learning. Hey, Jim. Jim, are you there? You're on mute. Do you want to say hello? Okay, Jim's probably driving. Yeah. All right. Are there any other topics you guys want to cover or ask Brent to touch upon? The gentleman with 2,600 doors in, is it 3 years now? Less than 4 years, certainly, right, Brent?
Yeah, I have a question. Brent, what markets are you concentrating, and what is your criteria for the future investments?
Yeah, no, really, really good question. I guess landlord business friendly is very important, right? We definitely want to look at, where the populations are moving, your population growth, your job growth. Those are great fundamentals and what's really attracting a market. And so, especially during this last pandemic, right, we've seen the importance of that. Yeah, Florida, I love Florida. It's a great market. It is hyper competitive. And so, we're definitely, looking at that market. Texas, definitely love that market and have had some good success there. And then Arizona, I found that for myself personally, too competitive. It's almost, if you're looking at deals and you're one of 40 people making an offer, then that's not a great place, got a great position to be in, right? Because you're 39 people effectively are not getting that deal and one is going to get it, right? So I like to get strong markets, but maybe not quite as hot as currently Phoenix right now, or I am actually should be finding out if we're best and final in a deal in DFW, but that market is crazy hot. So I don't know. I'm almost, yeah, Texas, Arizona, and Florida I love, but maybe not in the like super hot spots in those specific metros, like Hyde Park, for instance. There's the deal that just is going through the offer process in Hyde Park. It's like, Sam, do you remember what it was? Like 200 doors or something. Like that thing is going to have insane amount of offers. And yeah, I think you're just.
Okay. Yeah, that's great. That's where I mostly concentrate: Arizona, Florida, and Texas as a primary.
Yeah. What size deals are you going after?
Yeah, actually with, I don't want to mention the group. Yeah, they, the group I promote the webinars and everything, they go in class B plus in A neighborhood in the range of 20 to 50 above million. So at least 120 above units, mainly in a class B neighborhood, making sure, yeah, even I can go in depth of underwriting, but yeah, they mainly make sure the bad debt is not there during the COVID for the last, and at least 16 to 20 IRR, and then class B with the exit strategy, off market deals, and if there's a refinance component, things like that. I mean, I moved from class C to B, so mainly I concentrate on B class assets and things like that. Yeah, I invest passively, but also if there's a local opportunity like single family or small door, then I just want to partner with the like-minded people like you, San and Jim. Jim is a good friend, so from long back. So that's where we just want to see if there's any synergy that we can work together in the long term. Yeah.
I'd like to ask a question about risk, and it's for Brent, but maybe even for Mark and Raj, and for both active and passive. I've personally done a lot of research in thinking about sort of the multifamily risk in worst case, you know, the economy tanks, we go to war, whatever it is, right? But maybe starting with Brent, what is the worst case scenario for you as a GP, but also for your investors as LPs into multifamily? Like, how bad can it get in the stress test, in a general deal? And what do you see as the major risk that we should be aware of?
Yeah, no, and it's a great question, really, really great question. And I mean, that's ultimately what keeps people up at night. And
yeah, I think everybody understands the upside, right?
Yeah.
We all know we're investing for the upside, but very few people talk really deeply about the risk. I'd like to hear sort of, and maybe Mark too, since you seem like you're very active. Raj, you said 14, 15 passive deals. So it'd be great to hear how you guys think about the risk level.
Yeah, there's ultimately, you know, you look at the cycles, the economic cycles where we've, you know, kind of been through and been in. And you look at what's happened in the last cycles, right? Significantly has impacted the multifamily space. And you see deals that, you know, Phoenix, for instance, I think of all the markets, you know, definitely got roasted in the last recession, the last, you know, downturn. And so, yeah, I mean, there's definitely concern there. And if you're ultimately not able to, you know, if vacancy drops off, right? If you're not able to service your debt, you personally as a sponsor have to fund those things, or as collectively as a team, you know, you decide, are you going to hold on and weather the storm, or are you not, right? And so I think that's where you go back and then you look at that, you know, supply demand, those fundamentals of what's the population growth, job growth happening in an area, right? And even right now in the country, we're seeing that already happening in some places, in some, you know, New York markets and some California markets where you're having a ton of people leaving. And so they're going to have vacancy problems, right? You got debt, especially if they bought anything recently. You got very low cap rates, which means very high debt. And so you have a lot of bills that you have to pay. And so, yeah, I mean, that's for sure.
So Brent, just to probe deeper into that. So the deals that you're doing, that I'm doing, I think most of us are doing, whether it's active or passive, we're looking at 8 to 10% cash on cash. And you assume certain vacancy, economic vacancy. In the deals that you do, right, at what economic vacancy do we not cover the cash flow generally?
Yeah, so I mean, that's really the stress test that you do. I guess I can give a good example of this last deal that we did, right? So we looked at, hey, so our business plan is we you know, renovate the units, we bring them from here to here, right? So we're doing that. But what happens if you don't have any growth, right? What happens if your vacancy slips? And so you do a bunch of these stress tests, and then you look at, you know, kind of, okay, to meet that minimum debt service coverage that the lender often requires, or to make sure you pay all your bills, you know, where do you need to be at? And so I think those are very important stress tests when you actually, you know, going to buy a deal and to see, you know, what are your thresholds and where do you need to be? And so, yeah, definitely doing some of those stress tests and looking at vacancies.
So is it 65%?
Yeah, you know, that's a good question. I'd have to pull up the numbers, but yeah, it was something like that, where it was a pretty big drop. And then also just, you know, reversion cap rate, because you're kind of, if you look at a 5-year model, you're saying, you know, where is the deal going to be when I sell it? And that's a huge fluctuation. So if I'm saying, hey, we're buying it at 100 a door, but I'm anticipating the prices to drop, it's being very conservative. Versus if the market right now, if someone else is like, I'm buying it at 100 door, I'm expecting to sell it at 150 a door. So if that's what they need to do to be able to hit their model, hit the return, hit their investor yield, like what happens if that doesn't happen? What happens if it's flat? What happens if it goes down? And so really looking at that leverage, looking at that that impact, I think is a good way to mitigate risks. But yeah, I would love to hear from the other gentleman too.
Yeah, Mark and Raj, and it could be anyone that's done quite a bit of investing active. What
Yeah.
would be sort of your stress test, and have you seen it happen where actually the cash flows are not sustainable?
Yeah, I mean, I can speak about it. So depending upon, the main sponsor team, that's one thing to see they are full time into the game. What it means is they are focused on the niche in terms of whether it's class C or class B and multifamily. They're not into hotels and they're not into mobile home parks, things like that. They're not doing 100 things. So first thing is you need to make sure they are full time into this game. I talk from both GP level and from the investor level. So there are certain points. And the second thing is you need to really understand how many times they have exited, like the full cycles, and what markets they're investing in. And also, are they doing enough testing? Are they doing in emerging markets? Are they doing just from the neighborhood they are in? Depending upon, again, you need to make sure it's a mix of different job sectors, not just one. Like, for example, Orlando has tourism and jobs, and Austin has jobs and everything, making sure it's not like you are not doing a smaller city where there is no diversification of jobs. Because if one thing goes, if that particular company closes, then you end up losing all the tenants. So you need to be making sure the tenant is mixed. And also I look for how many unit mix, what type of, don't buy always one bedroom. So because you need to make sure 2 bedrooms, you're catering to the families. And then because if it is 1 bedroom, there is a lot of turnovers. So just to let you know, so you need to take into consideration of all that. And also, as Brent pointed out, you also need to look at exit cap rate, how they underwrote. Okay, is it cap rate expansion when they're exiting, or is it compression? So the trick that at least I think Brad and other people, they said at least 100 basis points or 70 basis points up in the exit criteria. And also you need to make sure you're not investing somewhere like a Jackson in Mississippi, like that. I'm just quoting a city just for example, where there's no growth. I mean, people you can get for houses very cheaply. So you need to make sure it's a diversification. And also you need to speak to the previous investors who have invested with them, because sometimes the sponsors won't tell exactly. They always tell the what are the good ones. But you need to figure out, okay, can I get 3-4 references and call those guys? Okay, how many times have you invested with them? Or you need to make sure, because, and also whether they can solve all the problems in the industry, how many years they are in the industry, what type of niche they are doing. I can talk about like the guy like Brian Burke. So I read a lot about the book. So I also like your book, Sam. So things like that, you need to make sure how the how they're structuring the deal. Are there more fees upfront? Whether they are investing substantial amount into the deal, or they're just taking the acquisition fee and then covering, they're saying, okay, we are investing in the deal. So there are a lot more I can talk in a lot of time. But again, you need to make sure you need to have all these kind of checklists, making sure you thoroughly vet the sponsors. And then, because I don't want anybody to lose their principal, that's the first thing. You need to make sure you're not losing your principal. And then, and also you need to trust the sponsor, making sure, because sometimes they may come into problem where, as you said, the stress test, all those things, but if it is not cash flowing, they cannot give it to you. So all the investors needs to understand, because at least you need to wait 6 months, And then when the asset is performing, they can recoup or cumulative accrue and then distribute it. So if you are just going with that and see if the guy is solving all the problems in the industry, then that's the guy to go with. And from GP perspective, again, you need to make sure, what level are you signing on the loan? Are you just into the asset management? And the critical thing for the sponsors is always the property management. And if you have a good property management, you can make good. But if you have a bad property management, then you are done with the deal because you cannot bring up the occupancy just like that. So it takes time, and also make sure your location and all those things. Yeah. So it's a lot more. Yeah, I can go on, but again, yeah, then I do have my own criteria when I'm investing, making sure those are all checks and balances. The reason I think is you need to get more educated. And the more you get educated on the groups like these or any events, and try to understand and take, always diversify your money, not just putting all your money in one bucket. So I also speak from the financial independence and Robert Kiyosaki on all that. So, and also make sure it's a good fit. Like if you are at a stage, what type of stage in your career, whether you're looking for a tax benefits, are you looking for you have a lot of money you need to write off, then you need to, depending upon the deal, you need to choose, because if somebody is giving like 50,000, if you put 100,000 into the money and they're giving 50,000 taxes, then you better, if you're looking for that, then go and invest. And also make sure, that's not the only criteria, because you need to make sure other things are okay. And along with that, this one. So, and also, yeah, I make sure it's always emerging and good markets. The more you invest, you always go to the higher end and then make sure it's stable asset, so that's what it is. Yeah.
Great. Thanks, Raj. That's good stuff. Good content. Hey, Mark, do you want to share? You sound like you've done quite a few deals as well. The question is really, what do you see as the worst case in some of the multifamily syndications you invest in or are involved in?
Okay, so I've done, I think 19 deals. I've had 3 lemons. Fascinating. My first deal that we got into ended up being a lemon. No. It was good on paper. It was good. Everything was good about it, but life happened. For example, it was in Beaumont, Texas. Well, a hurricane came by and just ravished everything.
Oh, wow.
So you're offline for the better part of a year to start with. The sponsors had insurance that covered part of it. Then there was a fire. So that knocked out other stuff. Then they found out the property manager had been committing fraud for the better part of a year and cooking the books. So there was a criminal part of that goes into it. So anything that can
Everything
go
that went wrong
went wrong. Now, here's the fascinating part about the sponsors. There were 4. There ended up being only 1 about 2 years into it. The other, there was a couple, and they went their own way in a bad sense. And it was just, okay, that sponsor, by the way, was able to had the means to carry, because there was no capital call. He carried it all the way through to the end. And then we got our capital back. So there was no loss of capital.
Wow.
That was critical for me, being the first one in. It's like, holy crap. So my point there is, I can look at the sponsors. I was in another one that had a couple of them that I had met and were involved in some other ones that were doing well. Well, this one ended up not doing well, same thing, and it just sold this year, but got all of my capital back. But it was a zero-sum game over those 3 years. So very few that I find within this one group, Brad's group, actually has cash flow projected that actually I get. I'm in another investment group, and there's no, my cash flow in that group starts the full month after my investment, after it closes.
So how many months?
The first full month after is when cash flow starts. And I find interesting too, the alignment of interests. So one group I'm with, asset management fee. If the cash flow does not go to the investors, they don't take an asset management fee. And the alignment there is, okay, if this is our projections and we're saying this is what we're going to do, well, obviously something didn't go right. It's our responsibility. So we're going to forego, our taking fees if we can't produce for the investors. So from my perspective, that's a great model to follow.
Wow, Mark, thank you. So 19 investments passive. How many years, Mark?
First one was in 2014.
Okay, and how many of those have gone full cycle?
7-ish.
7. Okay, and you said 3 lemons, I think, right, including this Beaumont one. And have you didn't lose money in any of them?
No,
okay.
and a number of them,
not yet.
a number of them I've got a couple 100% returns.
Okay, and you mentioned, so out of the 19, and you don't have to name groups, but we all kind of know, what percentage are staying true to the projected numbers more or less? Like, obviously it cannot be 100%, but like
so very few hit the actual target cash flow. They hit it after the appreciation and everything's cleared, but the upfront piece. So it's for me, I'm retired. I'm not living off that particular passive income. So I can afford to let it go a couple years and get it at the tail end. I'm okay with that.
Okay. So your net IRR eventually you think will be close to what was projected,
yes.
But the monthly or quarterly cash flows are, most of these deals are 8%, 10%, 11% projected. What would you say on average you're getting based on your 19 deals and your extensive experience?
I would have to look at my database.
But if you had to guess, like
it's all projected out. Let's see, because some of the lemons are in there too. So I would say probably closer to the 6-ish. One group that I'm with has preferred, so I can count on that. As a matter of fact, all through COVID, on one group, all but one, I was getting the same cash flow, nothing changed. So
great. So the preferred structure is good. Yep. Okay.
Yep. So a lot of times, just life takes over. There was a comment made by one of the coaches, said, first timers, don't kill them too badly if things go bad. So I think back, okay, when I met Brent and Randy on that Phoenix deal, I didn't know too much on Randy. I was very comfortable with Brent. Plus, he was Canadian, so I trusted him anyways. and it ended up being a great thing. So no issues there. So yeah,
fantastic. I just wanted maybe summarize a couple other points that I think Mark, very, very experienced, said. Like I looked at investing passively in another deal in this group that we're in, and it was just an amazing deal. All the numbers look great, but then, and there was a plan to refi 40-50% of the cash back to the investors in like year 2. But the asset management fee you mentioned, Mark, kind of killed the deal for me, because they had it was a fairly high asset management fee, and they intend to keep collecting that in perpetuity. Like they were actually not going to sell the property after refi, so they're going to just refi, give you 40-50% back, hold the property, but then just keep collecting both the property management fee and asset. And I'm like, wow, that's a lot of money for the sponsors, right? There was no reduction or anything, so it didn't work for me. So I think that's probably to your point, right, in terms of looking at some of these details of how maybe potentially greedy some of the sponsors are.
And it's important to look through all of those fees. And being a passive, right? I sit on my patio and drink wine. That's what I do in retirement. So I'm not doing any heavy lifting whatsoever, but the sponsors are. So they should be compensated, but it needs to be an alignment of interests. So if things are going crazy, they should not be getting all the rewards for that.
Yeah, makes sense. Great. Okay. All right. How are we doing on time here, Brent? Oh wow, we're way past 9 o'clock.
Yeah,
Sorry.
I know,
Maybe-
Mark. The wine is heavy lifting. That's don't fill that glass too high. I know. I tried to get my wife to bring me down, but
So maybe we'll just do one other question or topic, and then we'll close this up. Anybody have any burning questions for Brent or anyone else in the audience?
Let me ask a question. I guess Brent's probably expecting that. And thanks, Brent. You've been helping me with some answers. Some of my friends, including myself too, is all about this investing with tax, deductions, right? Depreciation, stuff like that. I did have some research done, but I guess I could try to ask question to, you guys who has a lot of experience. I think in ballpark, we could pretty much get 100% of the investor dollar, equal to the investor money as a depreciation, right? The deduction, not just depreciation, but also including things like I do a lot of small real estate investments, so the total expenses that are deductible could be equal to the amount that you invested in. Is that something that is feasible to say? Is it really possible?
yeah, so I guess I'd talk about that and love to hear you gentlemen as well. I know, so yeah, you're going to get on this specific West Chase deal. We're fortunate on that one where we're going to be able to have, or the modeling that we've had from Madison Spec is for 100% depreciation. And so, say you invest $100,000, then you get $100,000 in depreciation losses that you're able to use. And you would be, and I guess I'm not a tax professional. This is what I understand of it. But Mike, I believe you are qualified as a full-time real estate professional because this is everything that you do. So people have been able to use those losses to offset other taxable income within their, because they classify as a full-time real estate professional. So yeah, you have that you can use, but you'll get K1s. And then your K1 will show you kind of all your information, including your depreciation. But Mark,
okay, I'm sorry. I'm just trying to ask questions like for you. Even let's say the next question would be like, where's the next project of you guys, and is it realistic to expect similar type of deductions? Because a lot of my friends are asking similar questions, right? If you invest 100,000 and you're in a 25% tax bracket, you're really just investing, you're saving $25,000 taxes. So you're looking at, instead of putting out 100,000, you're really just investing 75,000, right? In reality. And so it's kind of important for me to know, like, all these projects. I'm sure every time you have a new project, you probably will disclose, like, all these IRRs and cash on cash, but it's not very clear on the deduction part of it, where you do accelerated depreciation, or you do those cost segregation type of things.
yeah, so I mean, we'll always do those on every single one of our projects, and I guess that's the one thing about bigger projects is you have the economies of scale to be able to do that, right? So say your study costs you $5,000, for instance. If you have a single family house, that's a lot of money to spend, but on a bigger project, that's a smaller piece of the pie, and you're able to use that and create a lot of depreciation leverage. Ranges 100% is what is forecasted on that specific project, and I do have it on another project as well. But it does range, and I think maybe, I don't know, Mark, what you're seeing, or Raj, are you seeing kind of 60, 70, 80%? Maybe it's more common on your depreciation.
Yeah, the 70 is what I've seen. And just as a data point for the accelerated depreciation, that law ends December 2022.
Right.
Oh, that's so Biden did that, or
Trump had it set up in the Trump tax reform where it was triggered that it was going to be collapsing at that time. And so maybe he had intentions of renewing that. or I don't know what the plan was, but yeah.
Thank you. So 70% is more like the norm then.
On the project, but I think that's
Yeah.
a better benchmark, right, Mark?
Yeah, I think
Yeah.
you have to
Yeah.
count from 50 to 70% is a normal thing, but getting 100%, you need to be, I have seen ones in mobile home parks, in multifamily, it's only few projects, that too, not easy to get 100%. Yeah.
Okay, thank you. Now, also, if the I guess if the real estate investment is doing much better than estimated, then I think the tax implications it means you have more income, I guess, more profit too. On the other hand, if fell short of the expectation, then maybe you have even more deductions, right? Because the operation expense is going to be higher, income is going to be lower, less occupancy, things like that. I would assume it's similar to smaller multifamily investing. It's very similar that the expenses, if you're not doing well, the expenses are higher, income's lower, and therefore.
You mean it's doing so badly that you're operating at a loss, Mike?
No, I would just say the net operating income would be lower, right? And therefore, you may not have a loss, but your deduction would be less. It would be more if you're not doing too well. You're gonna have higher expenses and low overall if you're not doing well.
Then there won't be any. There won't be any profit sharing because NOI is not profitable at all. So you'll get your capital, but you're not going to get any returns. So
no, I'm not talking about. Okay.
But you're right.
But in the K1, I'm sorry, but K1 distribution will include all the number would be lower, right? The income would be lower.
They're not going to pay anything unless it's outperforming their projections. So so you're not going to have any income. Yeah.
Okay, got it. Okay, it's the syndication itself that is doing bad, but then when it costs to individual.
And for the people that are not full-time real estate professionals, like Mark, I assume because you're retired, you wouldn't classify as that full-time real estate professional.
Yeah, so at the time I was still a W-2, so I could only write off a certain dollar value of my accelerated depreciation or all of the depreciation that I built up over the years. So when I retired, now I can officially be a full-time real estate professional. So I've got a little over 800,000 in expenses to write off. So the good news is my wife's still a W-2. And so it's just a matter of sitting every year with my tax lawyer and attorney and CPA and saying, okay, what makes sense for us? What do I want to write off this year? And just carries year to year to year.
Fantastic. That's fantastic.
Awesome.
Good.
That's the greatest position to be in.
Yeah.
You have, and I guess whatever is not used, you can carry over. That's what you said, right?
Yes. Yeah, because you've earned it as part of the deal.
Mm-hmm.
Jenny, that's you. That's you soon, Jenny. Okay. Hey, we're approaching 9:30. It's been amazing discussions, great questions and participation. Raj and Jenny, Mike and Mark, Kona and Shirley, we hope to hear more from you next time as well. But I wanted to get Brent back to his kids. That's why we do this, so he has time to spend with his kids at bedtime. But hey, Brent, amazing, man. I've known you for a while now. It's good to kind of dig deep and really get to know you even better. So thank you so much.
Awesome. I'm definitely honored and appreciate the opportunity.
Yeah. And thanks everyone for joining and contributing. Fantastic.
Thank you.
We'll put this on.
Thank you. Everybody be safe.
Okay. All right. Good night.
Thank you.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards.